Look, let us sit down and talk like adults for a second because what I am about to tell you is going to make your neighbor who mows his lawn at 6 a.m. look like a financial genius if he is holding the right tickers. My next door neighbor is actually an oil trader for a massive refinery down in Alabama, and he just leaned over the fence yesterday with a smirk that usually means he won a bet or found a loophole in the tax code. He told me his firm already hit their full year 2026 cash flow target. And folks, I need you to check your calendar because it is only May 13th, 2026. When a mid-sized refiner in Alabama is already 8 months ahead of their annual plan, you better believe the kings of the jungle like Chevron, ExxonMobil, and ConocoPhillips are sitting on the biggest pile of cash this industry has seen since the peak of 2008. The only real question left for us to answer is what exactly are these executives going to do with all that green before the auditors start asking questions? Today, I am going to tell you exactly where that money is flowing, because in this game, if you are not at the table, you are probably on the menu. Brent crude is sitting comfortably over $100 a barrel, and if you look at the geopolitical map, it is probably heading toward the moon. The Strait of Hormuz is half shut or fully shut depending on which Telegram channel you follow and who you ask on which day of the week. Iran and the US are nowhere close to an agreement, and American oil companies are quite literally printing money while the rest of the world is arguing about carbon footprints. I want to show you two sleepy, boring, almost invisible stocks that are likely to get bought out for a 30 to 50% premium before the ball drops on New Year's Eve. The big oil majors are hungry, and they will almost certainly pull the trigger on these acquisitions before this year is over. Be sure to subscribe to the channel right now because when the market is this volatile and this profitable, you need to be taking advantage of every single opportunity to grow that pile of yours. Let us dive into the hard math on Chevron because numbers do not have feelings and they do not lie. Their production is up a staggering 15% year over year, and their US refineries hit record throughput back in March when everyone else was complaining about inflation. ExxonMobil is currently on pace for over $40 billion in free cash flow this year. Alone, Conoco is looking at another 15 to 20 billion in the bank. That is conservatively $80 to $100 billion of excess cash piling up on the balance sheets of these three companies. In a single 12-month cycle, Wall Street analysts are screaming for buybacks and retail shareholders are begging for higher dividends so they can pay for their overpriced lattes. But that is not what oil executives actually do when they are holding a war chest of this magnitude. You do not grow a $100 billion oil empire with just buybacks. You do it with acquisitions, specifically vertically integrated ones that make your competitors look like they are playing checkers while you are playing 4D chess. It makes life simpler for the board, and it generates a hell of a lot more profit. For the long term, you buy the pipelines, you buy the gathering systems, you buy the processing plants, and you buy the export terminals. You want to own every single inch of the pipe that connects a muddy well in West Texas to a refinery on the Gulf Coast and eventually to a massive tanker heading to Asia. Exxon already swallowed Pioneer and Chevron already grabbed Hess. That upstream consolidation is mostly in the rearview mirror. Now, what is left is the midstream plumbing, the stuff nobody talks about at dinner parties because it is not sexy. There is one sleepy mid-cap pipeline name sitting right slap in the middle of Chevron's biggest production region in the Permian. This company spent the last 6 months quietly reshaping itself into the cleanest, most attractive acquisition target in the entire energy sector. The company is Plains All-American Pipeline, and the ticker is PAA at roughly $22 a share today. Plains is worth around $15.4 billion. To put that in perspective, that is less than 1/20th the size of Chevron. It also pays a massive 7% dividend. So even if no one buys it, it is a total cash cow for your portfolio. Plains moves over 7 million barrels of crude oil and natural gas liquids every single day. They own the largest crude oil gathering and pipeline network in the entire Permian Basin. This is the same Permian Basin where Chevron is the second largest producer behind only the new Exxon Pioneer combination. Here's what makes PAA such an obvious screaming target right now. For the last 6 months, Plains has been quietly cleaning out the garage and getting ready for a sale. Just yesterday, on May 12th, they officially closed the sale of their Canadian NGL business to Keyera for $5.3 billion in cold hard cash. They also recently bought 100% of the EPIC crude pipeline system for $1.3 billion. So as of today, May 13th, Plains is a pure-play Permian crude oil midstream company with billions in fresh cash sitting on the balance sheet. Maybe this is all a huge cosmic coincidence, but to me, this looks like a company putting on its best suit for a buyer. There is exactly one logical buyer here, and that is Chevron. Chevron pays Plains tens of millions of dollars in pipeline tariffs every single year just to move their own oil out of the Permian. That is every barrel, every single day, year after year. It is like a toll booth sitting on the neck of the largest oil major in America. If Chevron buys Plains, those tolls disappear instantly. They pick up dedicated pipeline capacity for decades to come. They get an export terminal in Corpus Christi that lets them ship straight to buyers in India and South Korea. Those are the international buyers who are actually paying the premium prices for American sweet crude. The math is staggering when you actually write it down on a napkin. At a 35% premium to today, S price, Chevron could acquire every single share of Plains for under $21 billion. Plains throws off roughly $2.7 billion in adjusted EBITDA. The deal basically pays for itself in synergies and cost savings in about 7 years. For a company like Chevron that generates $4 billion a quarter in free cash flow, this is a total no-brainer. PAA stock is up on the year, but it has been consolidating and moving sideways since early March. This is exactly what it looks like when smart money and institutional players quietly accumulate shares before a buyout. By the way, if you like this kind of deep dive and you want to see exactly what I am buying in my own account, you need to join my Black Ops trading service. For just $5, you get an entire year of access to the inner circle. That includes live 1-hour weekly mentoring sessions with me where we rip apart charts and balance sheets. You get a second session every Thursday, bonus reports, and a bi-weekly newsletter that cuts through the noise. It is $5 for 1 whole year of professional grade guidance. Absolute no-brainer if you are serious about your money. Click the link in the description or scan the QR code on the screen to get signed up before I change my mind. Now, we talked about Plains, but you do not have to bet the whole farm on just one horse in this race. Plains is likely just one of several public companies that get snatched up in this massive acquisition cycle. That brings me to the second name on my list, which is the dark horse of the sector, KNTK Holdings, ticker KNTK. It is trading around $48 a share with a market cap of only about $8 billion. This is less than half the size of Plains, and it is tiny by big oil standards. KNTK owns gathering systems and processing plants in the Delaware Basin. That is the most prolific subbasin of the entire Permian. Their assets are literally adjacent to Chevron's most productive acreage in West Texas and New Mexico. A buyout here would be absolute pocket change for a giant like Chevron, but it would lock in midstream takeaway for some of the highest margin barrels in the entire U.S. oil patch. Wells Fargo upgraded KNTK to overweight back in March. Truist initiated coverage at a buy, and the smart money is definitely starting to pay attention. KNTK just issued 2026 EBITDA guidance of nearly $1 billion. That is an enormous amount of cash flow for an $8 billion company. It is an absolute no-brainer bolt-on acquisition that adds immediate value to the bottom line. Big Oil is sitting on a generational pile of cash, and the best way to figure out what they are going to do is to follow the money. If a CEO wants a raise, it has to be voted on by the board and the shareholders. But almost all of them have performance-based bonuses tied directly to the stock price performance. They are financially incentivized to see that ticker go up by any means necessary. Dividends do not make a stock go up. They technically make it go down because you are taking money out of the corporate treasury and giving it away. They could do buybacks, but the Inflation Reduction Act of 2022 put a federal tax on those transactions. You know what is not taxable? Acquiring another company that is a tax-deductible expense that materially increases the company's value for years into the future. PA fits this mold perfectly, so does KNTK. These are pure-play midstream stocks that unlock serious value for the giants. If and when these buyouts happen, the move in the share price is almost instant. By the time the news hits your Twitter feed or your favorite news app, the stock will already be up 30 or 40%. You cannot wait until the news breaks to buy in, because by then the profit has already been made by someone else. You have to be positioned in the stock before the PR wire goes live, and the world finds out if they get bought out. It is almost impossible not to make a significant amount of money. Buyout offers always come at a price above where the stock is currently trading in the open market. This is what we call the takeover premium. No board of directors would ever approve a sale for a price below what the market says it is worth. You typically see that 30 to 50% premium to entice the current shareholders to say yes. If a stock was at 100, they might offer 140 or 150 to get the deal done quickly. The next morning, the stock gaps up to that price and sits there until the lawyers finish the paperwork. Which of these two is the better bet for your hard-earned cash? Personally, I like PAA a little better right now because it is the cleanest setup. After yesterday's $5 billion sale, they are lean and ready to be integrated. It is cheap, it is profitable, and it is strategically necessary for anyone drilling in the Permian. KNTK is slightly more volatile, but it might have more percentage upside if a bidding war starts between the majors. Keep an eye on both of them. As soon as one gets bought, the other will start to move as investors reprice the whole sector. Don't forget to subscribe and click the link in the description for the Black Ops trading service. It is the best $5 you will spend this year, and your future self will thank you for it. I am done talking for now, so go out there and get after it. I will see you in the next one. Stop chasing shiny objects and start following the cash flow, because the cash flow never lies. You have to realize that these big oil companies are not charities. They are machines designed to maximize returns for the people at the top and the shareholders who are smart enough to ride along. When you see a balance sheet with $100 billion in cash, that is not a savings account. It is a loaded weapon. They are going to fire that weapon at the midstream sector, because that is where the bottleneck is. If you own the bottleneck, you own the industry. Plains All-American and KNTK are the two biggest bottlenecks sitting in the most important oil field in the world. Chevron knows it, Exxon knows it, and now you know it. The difference between a successful trader and someone who just talks about the market is execution. I have given you the tickers. I have given you the logic. and I have given you the price targets. Now it is up to you to decide if you want to sit on the sidelines or get in the game. The 7% dividend on PAA is your safety net while you wait for the buyout news. You are getting paid to wait for a 40% gain. Where else are you going to find that kind of risk to reward ratio in 2026? The market is at all-time highs and everyone is nervous, but energy is the one place where the fundamentals are screaming buy. Get your head in the game and pay attention to the midstream play. I have spent 20 years watching these cycles and they always end with the big fish eating the small fish. We are just picking which small fish look the tastiest to the sharks. Don't be the person who comments on this video 6 months from now saying you wish you bought in. Be the person who is posting a screenshot of their gains in the Discord. I am out of here to go check the Brent crude futures again. Stay sharp, stay hungry, and for the love of everything, stop buying meme coins with your rent money. Invest in real assets that move the world. Oil is what moves the world, and right now, the money is moving into these two stocks. I will catch you on the live stream this Thursday for the Black Ops members. Until then, keep your stop losses tight and your eyes on the prize. The wealth transfer is happening right in front of us, and I am not planning on missing a single dime of it. See you in the next video, and let us get this bread.